Alice helps us to remember the fundamentals of accounting. It stands for assets, liabilities, income, capital, and expenses. Assets are things owned by the business that has future value, for example, cash in bank. Liabilities are what a business owes to others. Income is revenue received for selling of goods or services. Capital is an investment made into the business. Expenses are payments made for activities of the business, example, salary expenses. From Alice, both income and expense transactions are transferred to income statement where a profit or loss is determined.
An asset is a resource with economic value that an individual, corporation, or country owns or controls with the expectation that it will provide a future benefit. In simple terms, an asset is something you own. Assets are purchased to increase the value of the company or benefit the operations of the company. Some examples of assets are inventory, supplies, accounts receivable, and cash. Assets make up the A in Alice, which is used to help accounting students understand the basic aspects of all business transactions. They form one side of the accounting equation, with liabilities and owner's equity on the other, and are also reported on the balance sheet along with liabilities and owner's equity. Assets can either be tangible or a physical substance, such as land, or intangible, something that is not physical, for example, a patent. Finally, assets can be classified as a current asset or a non-current asset. A current asset is an asset that is sold within 1 year, is principally held for trading, or as a cash or a cash equivalent, such as cash at bank, inventory, or accounts receivable. A non-current asset, also known as a fixed or long-term asset, is an asset that is held for longer than 1 year, for example, office equipment, motor vehicles, land, and machinery.
In regards to Alice, the L stands for liabilities, which means what businesses owe to another entity. It can be further defined as external claims of individuals and organisations that have arisen due to past transactions or events. Some examples include account payables, bank overdrafts, personal loans, taxation, and mortgage. On the balance sheet, liabilities are classified as either current or non-current. Current means amount due for settlements within 12 months, whereas non-current means a longer-term liability. Liabilities on the balance sheet can show the financial obligations of a business, which means that increased liability would mean there's a higher risk on the business. Liability is displayed in a company's balance sheet, also known as the statement of financial position and the statement of cash flows.
Income increases in economic benefits during the accounting period in the form of inflows or enhancements of assets, or decreases in liabilities that result in increases in equity, other than those contributes from equity participants. Let's move on to the types of income. There are two types of income. Number one is sales revenue, income earned from ordinary courses of business. Number two is gains, income that does not arise from core operations of the business. For instance, sales revenue of a business whose main aim is to sell biscuits is income generated from selling biscuits. If a business sells one of its manufacturing machines, income transactions would be classified as a gain rather than sales revenue. Let's move on to some examples. Following the common sources of income recognized in financial statements: sales revenue generated from sales of a commodity, interest received from a bank deposit, dividends earned, gain on re-evaluation of company assets. There you go. That's income. I from Alice.
Capital, also known as equity, refers to any financial resources or assets owned by a business that are useful in furthering its development and generating income. It can also include assets such as investments, stocks, and other assets that are more long-term and could benefit the company in the future. Capital involves the aspects of a company that help build and improve it, that form its base for generating revenue. Because capital is owned by a company, it is protected. However, capital ownership can be transferred or sold. Capital is equal to the total number of assets minus the total number of liabilities, and is affected by the following: initial or additional contributions from the owners in the form of investments, withdrawals made by the owners in the form of dividends, and income and expenses. Owner contributions and income increase capital, while withdrawals and expenses decrease it.
In formal terms, expense in accounting is the money spent or cost incurred in an entity's effort to create revenue. Expenses represents the cost of doing business. Expense is the E in ALICE, which helps beginner accountants understand the basics of business transactions. To help remember, expenses simply mean to spend funds, and happens when we use assets or other resources to create profit. Expenses is used for a variety of things in accounting. They aid an unbiased and honest financial statement and assist in creating relevant, faithful representations of a business entity's information. Examples of expenses are things like salary and wages, any repairs, insurance, power-related things such as heat, internet, telephone, and light, as well as motor vehicle maintenance.